Every single investor is saying the property market is slowing down. So simply, which state do you actually buy in right now? And which ones do you avoid? We've pulled the data, we've expanded the research across all 5 major states, growth rates, vacancy rates, yields, population flows, cycle position, you name it. In this video, I'm going to break down where the real opportunity sits in 2026 and why some markets are holding strong while others are softening. And I'll give you the clear verdict where you could potentially put your money in. Let's just get into it now. Let me start by telling you what the data and the research is actually showing and what most investors are getting completely wrong. We're no longer in a one market lead. Everyone else is following cycle. We're in a broadening cycle. Capital is dispersing beyond the obvious East Coast favorites, moving toward markets where affordability, yield, and growth momentum still align. This is the biggest shift I'm observing right now. Let me walk you through each state. New South Wales, Sydney, we've seen a 12-month growth of about 6.4%, a median price point of 1.2 mil, gross yield of a whopping 2.8%, and a vacancy of 1.3. The cycle stage is mid to potentially in the later end, but New South Wales continues to sit in a narrow band, consistent, not exciting. Sydney entry prices remain a lot harder to get into and yields are really compressed at that price point. A 5% correction would still leave median prices about the 1.1 mil, limiting your buyer pod depth significantly. The smart money in New South Wales right now isn't going into Sydney Metro. It's going into selective regional affordable plays, Dubbo, Orange, and so forth. Vic Melbourne, snapshot of about 2.1% growth, median of 773k, a gross yield of 3.7 and a vacancy of 1.7 on average. Victoria is still the anchor state in terms of research activity, but its share of investor attention has clearly compressed. And that's what I want you to understand about that. Victoria is moving from dominance into a little bit of a rotation, and rotation is an opportunity to capitalize on. Still dominated within established suburbs showing growth corridors of Craigieburn, Werribee, Point Cook, Brookfield. What's strange is that Victoria is now part of a national opportunity set and not just a whole story. Let's move up into North Queensland, Brizzy. We've got a 12-month growth of 8.2%. Median price point of 862, your gross yield 4.1% and vacancy just under 1%. Queensland is steady, but it's no longer the standout growth story that everyone assumes. Become a little bit of a stable allocation state rather than the exciting one. The lowest vacancy rate of a major capital city at 0.9%, and that's a good signal. Yields are above 4%, one of the strongest cash flow markets nationally. But within Queensland, the opportunity is diversifying internally, spreading from Ipswich into central Queensland, Townsville, Cairns. Don't just buy Brisbane and assume you've bought Queensland. It's now moved to the west coast of WA Perth. Your snapshot, what we're looking at a 12-month growth of 12.6%, median pricing going into 800s, your gross yield at 5.2%, vacancy at 0.6%. Now, Western Australia is a big story of a cycle. 12.6% growth in the past year, despite a softening national market. Mining sector employment, great interstate migration, chronic undersupply. The fundamentals have been there for a while and most investors were simply late to re-engage with them. Perth's vacancy rate is 0.6% and that is an extraordinary number. The question now isn't whether Perth has run, it's whether you can still find pockets with upside remaining. SA, Adelaide. We're looking at a 12-month growth of 9.8%, a median price point of 720k, gross yield of 4.6%, and a vacancy of 0.8%. This has confirmed what earlier research and data has been hinting at. This isn't one off the spike. Strong population growth, relative affordability, and a vacancy rate of under 1%. SA is building a little bit of a real conviction for momentum that may be softening affordability while it tightens there. So watch it quite carefully. And I guess the narrative that investors are getting wrong, most investors are still thinking in the older hot headlines. And that old narrative is simply Victoria's dead, Queensland has run too hard, WA has already gone, regional markets are way too risky. But the data tells us a more nuanced story. The market narrative most investors are getting wrong is assuming this cycle is about timing one boom market. It is simply not. It's about allocating across multiple markets with different drivers at the same time and building a portfolio where each property complements the next. The second big misconception is about suburbs which are being targeted. A lot of investors assume the smart money is always chasing prestige, lifestyle-driven areas, proximity to the CBD. That is fundamentally flawed. The investment phases has shifted to middle-class suburbs where the maths works and not a dinner party brag. The average investment grade suburb now, in my opinion, sits at that 730K band compared to that 1 million across a lot of research suburbs. There's a massive clue. Follow affordability at suburb level. Follow compounding. Follow supply and demand imbalance. Follow the growth pyramid method and stop anchoring it your 1980s or labels of proximity to the CBD. How we match a client to the right state. Before I give you the verdict, I want to spend some time to show you the framework we actually use, because the right state for you depends entirely on your starting position and what your portfolio needs to compound on. I simply never begin with a state name or a suburb name. We begin with you, the investor. The step one is to define the investment objective. What does a property need to do for you to get you to the next step? Simple. Is it long-term capital growth, cash flow support, future equity uplift, portfolio diversification, or specialization? Different goals require different market conditions, different risk levels, and different asset qualities. Step two, you match that brief to the right market profile. Once the objective is clear, we determine the type of market that best suits it. Are you better aligned with a stable, lower risk market, a market with stronger current momentum, or a market with tighter conditions with high rental demand, or a balance of growth and income? At this stage, I am not selecting a state. We are defining the market profile required to support the outcome that you are chasing. Step three, that's where I applied the layered Insighto growth pyramid method. We assess locations across 6 layered metrics, and we never rely on one single number in isolation. There's 6 layers of affordability, supply, days of market, future supply risk, rental strength, cycle positioning, fundamentals. A suburb may show strong recent growth, but if affordability is on a decline and supply is rising, the outlook might be weaker than it appears. Quieter looking market with tightening supply, improving demand, and an early cycle turn can now represent a much stronger buy. You layer these metrics, and this is how we separate genuine opportunity from market noise. Step 4, that's where we start compressing and narrowing it down to the right states, the right region. Only once a brief and market profile are defined do we then determine which state and regions to target. I don't select a state first and then justify it. We identify what type of a market is needed, then find in Australia those conditions that exist. Number 5, you shortlist suburbs, then select the asset. Even within a strong suburb, not every property will make a suitable investment. We assess a specific asset against your portfolio at purchase price versus budget, property type, tenant appeal, scarcity, hoarding strength, and portfolio fit. The recommendation must work in practice and not just on paper. So the verdict, where would I buy, and simply on home ground in Victoria? And not that's just where would I buy in Victoria. And that's not because I am a local Melbourne Victorian. It's not because also that Victoria is outperforming right now. In fact, it's simply the opposite. Sentiment has been a lot softer, activity has been a lot more subdued, and many investors are sitting on the sidelines while others have moved elsewhere. And that is exactly what creates opportunity. Data, research suggests that Victoria is sitting in its early turn phase of a cycle. Much of a bit of a downside has already been absorbed in sentiment. The next phase of growth hasn't yet been fully priced into the right segments of a market. That creates a more favorable risk-adjusted position. You're not chasing momentum, you're positioning to be ahead of it. In practical terms, what does that mean? This means you're entering before that competition comes back and intensifies. before confidence returns back in, before prices are pushed up by renewed demand. And what I buy in Victoria is simple. I wouldn't be buying broadly across property types. It would simply be very targeted by establishing housing in an owner-occupied driven suburb, a functional family home with strong underlying demand and limited supply, where renters are in minority. These are the assets that tend to lead in a recovery phase, supported by real demand from families and not just speculative investor activity. Better scarcity, stronger pricing power, more resilience, long-term performance. And obviously what to avoid. You guys all know it. New apartments, investor grade units, high density precincts, far more exposed to that oversupply and slower recovering dynamic. Now, the value add play. If the phases is capturing the next leg of a cycle, you want assets where you can control and simply force equity on your own terms. Value add strategies would be an additional bedroom, a targeted cosmetic renovation, a corner block, or future subdivision potential. The distinction comes down to timing and asset selection. You don't rely on the war, the RBA, or fuel prices. You simply take control of your asset and manufacture your own upside. Where I'd be telling a client, potentially wait or be a little bit more cautious is across into Western Australia. Look, Perth's fundamentals are generally strong. Vacancy rate, population growth, the yield are all solid, but a significant portion of the growth has already occurred. And most investors tend to chase what is currently performing. The more effective strategy for some is to identify where the next wave is likely to form, not crowd into where the last wave has already broken. Right now, based on the data and our on-the-ground buy activity and 2025 market observation, that next wave is forming in Victoria. But hey, if you need fast equity under buy and hold strategy, Perth, WA could definitely be your market to be looking into. So to summarize, don't discount WA on the basis of this. If you need that fast equity momentum uplift from a buy and hold, WA has the right fundamentals that would be suiting this profile. We are in a diversification phase of a property cycle. Investors are spreading conviction across affordability, high utility markets, and not crowding into one dominant state or a prestige narrative. The opportunity right now is often where affordability, market compounding, and research attention are quietly converging first, and simply not where the media noise is the loudest. If you have found this valuable, you guys know what to do by now. Click that subscribe button. We publish every week with the data, the research, the analysis, the on-the-ground perspective. Drop a comment. Which state are you looking at buying right now? And let me know below. And this time, I am in the studio, not driving around, saving on fuel prices. So see you on the next one.